Welcome back to The Explainer. Today, we are diving into a massive mission. We're going to uncover exactly how everyday retail investors are actively trying to bypass traditional financial barriers to get their hands on the private space and AI economy. We are looking at a fundamental shift here, a complete rewiring of how the most valuable companies on Earth are built, funded, and ultimately traded. So grab your notepad because we are breaking down a wild Wall Street hack that is literally reshaping the markets right under our noses.
So here's the hook. Think of SpaceX as the ultimate, ultra-exclusive private equity VIP club. You can see the flashing lights, you can hear the music thumping, but there's a velvet rope and, let's be real, you are definitely not on the list. Historically, unless you were an institutional billionaire, there was absolutely no way you were getting in. But recently, well, some clever financial bouncers have kind of propped open the kitchen door. The buzz in financial circles right now is literally this. SpaceX isn't public, but Wall Street just built a backdoor. Here is how to own a piece of Starlink and the Anthropic data center for under $100. It's a crazy concept. You're getting a piece of Elon Musk's orbital logistics network and heavily sought-after AI infrastructure for less than the cost of a nice dinner out.
And the data backing this up is absolutely fascinating. Just look at the massive surging search volume for a SpaceX IPO. I mean, retail investors have been eagerly anticipating this event for years, right? But on the flip side, absolute silence. There are virtually zero mainstream search results out there breaking down indirect ETF exposure for the specific asset. This is a glaring gap. It shows the massive disconnect between what the public is desperately searching for and the silent alpha that Wall Street is actively trading right this second. The smart money? They aren't sitting around waiting for the IPO. They're already inside.
Okay, let's dive into this. Here is our roadmap for the Explainer today. We'll be covering 1. The SpaceX ETF backdoor. 2. SpaceX AI and Colossus 1. 3. The Anthropic compute deal. 4. Hacking the private market. 5. The brutal truth of fees. And 6. The 2026 IPO trap.
Section 1. The SpaceX ETF backdoor. Moving right along to Section 2. SpaceX AI and Colossus 1.
To really grasp why SpaceX is marching toward an absolutely staggering anticipated 2026 IPO target valuation of $1.75 to $2 trillion, we have to look at the recent formal integration of Elon Musk's AI venture, xAI, straight into the corporate structure of SpaceX. Just look at the foundation they're building here. You've got the SpaceX launch and Starlink division valued at roughly $1 trillion. That's your global logistics, your connectivity, and a massive rock-solid revenue base. Then, you slap on the newly integrated xAI division, valued at $250 billion, which brings in cutting-edge artificial intelligence and compute infrastructure. By smashing together global orbital logistics with top-tier AI, they're creating a competitive moat that is just impenetrable. It's a vertically integrated, sovereign-level infrastructure beast that traditional tech giants simply can't replicate, mostly because those competitors are stuck dealing with terrestrial limits like real estate and local power grids.
Section 3. The Anthropic compute deal.
Now, this is where it gets really interesting. This step-by-step breakdown is an absolute masterstroke in data center history. Step 1. SpaceX AI builds the Colossus 1 facility in Memphis, Tennessee. We're talking a massive cluster housing over 220,000 NVIDIA GPUs built in an unprecedented 122 days. I mean, that was undoubtedly fueled by a localized shortage of energy drinks, right? Step 2. As they expand to an even larger Colossus 2 facility, they migrate their internal Grok AI models over to the new hardware. And then step 3, and this is literally brilliant, they turn around and rent the entirety of Colossus 1 to Anthropic, who is one of their direct rivals. They took this massively overbuilt infrastructure, drawing over 300 megawatts of power, and just instantly transformed it into a guaranteed high-margin revenue stream. It perfectly proves that the infrastructure layer of AI is a totally separate asset class that can be heavily monetized.
Section 4. Hacking the private market.
Now, what's really fascinating here is the sheer concentration of risk and cost. We're looking at three main vehicles acting as short-form pivots for everyday investors trying to grab private SpaceX shares. First, there's XOFVR, an ETF that pivoted to hold private companies. Next up is DYZX, a closed-end fund with a 16.2% weight, and then ARKVX, an interval fund sitting somewhere around 14 to 17%. But you really need to notice the extreme spike in the XOFVR weighting. It is sitting at nearly 43%. Now, that isn't necessarily by design.
It's actually a dynamic shift caused by outflows in their public holdings. Basically, as investors pull liquid cash out of the fund, it leaves behind this heavy, hyper-concentrated brick of illiquid private SpaceX shares.
Which brings us to Section 5, the brutal truth of fees.
Okay, brace yourselves and look closely at this number, 92.94%. This is the staggering premium that the Destiny Tech 100 fund, ticker DXYZ, traded at over its net asset value back in May 2026.
To really understand why that is so wildly dangerous, we've got to define premium to NAV. Basically, it's the excess price an investor pays over the actual underlying market value of a fund's private assets. You see, because closed-end funds like DXYZ have a fixed number of shares, intense retail demand can push the stock price way higher than what the assets inside the fund are actually worth. Think about what that math actually means in the real world. A 92% premium is effectively a 104% markup. You are literally paying more than double the fair value just to get your foot in the VIP door.
And this brilliantly illustrates the trap. Let's break down this price disconnect. The actual asset value of your share is $100, but what you, the retail investor, end up paying on the open market, $204. So the absolutely crucial takeaway here is this. Even if the highly anticipated SpaceX IPO is a total smash hit, and the underlying company valuation surges by 50%, the premium on this fund could just collapse right back to its net asset value. If that happens, the underlying assets went up, but your portfolio, it still loses money. It's wild.
And honestly, aside from those premiums, there is the sheer brutal drag of the fees. To put that into perspective, a standard passive S&P 500 index fund might cost you 0.03% a year. But the backdoor ETF cost? You're looking at a massive 4.53% total expense ratio for a fund like DXYZ. And for funds like XOVR, you get hit with fee stacking. The ETF itself has a fee, but it also holds a special purpose vehicle, or SPV, which holds the SpaceX shares. And guess what? That SPV has its own hidden management costs buried deep in the fine print. So you aren't just paying for the asset, you're paying layers upon layers of middlemen fees just for the privilege of indirect access.
Finally, Section 6, the 2026 IPO trap. This whole house of cards really hinges on SEC Rule 22E4. Now, this rule dictates that open-end ETFs are strictly prohibited from holding more than 15% of their net assets in illiquid investments. And private company shares, by definition, are illiquid. But as we established just a minute ago, XOVR's SpaceX weighting spiked to an alarming 42.7% because liquid public assets were flowing out of the fund. So, what happens when a fund becomes structurally broken like that? Well, to regain compliance, the fund's managers might be completely forced to sell their highly prized SpaceX shares in the secondary market. And here's the kicker. When buyers know a seller is under regulatory duress to liquidate, they demand steep discounts. A forced fire sale could cause retail investors in this ETF to take a massive loss, completely missing out on the upside of the actual IPO pop.
So what does this all mean? We are left with a pretty critical question. The SpaceX IPO is expected to be one of the largest public listings in history, with rumors floating around of a promised 30% retail allocation straight from the company itself. So will you pay double the net asset value and suffer heavy, stacked management fees for a high-risk backdoor ticket today? Or will you exercise a little patience, sidestep those Wall Street bouncers entirely, and just wait for the 2026 IPO tsunami to hit? The private market is absolutely more accessible than ever, but as you've seen today, convenience comes at an incredibly steep price. Keep learning, keep analyzing the structures behind these trades, and I will catch you in the next explainer.